Gold enters the human story before written history begins. Ancient people didn't discover gold by mining first. They found gold lying in riverbeds, scattered among stones and sand. Nature had already purified it. That is why early humans believed gold was divine. In ancient Egypt, gold was called the flesh of the gods. Pharaohs weren't buried with gold, they were buried as gold, believing it would make them immortal. In India, gold appears in the Rig Veda, linked to Surya, the sun. Lakshmi wasn't the goddess of gold. Gold was believed to be Lakshmi in material form. In Mesopotamia, gold and silver were weighed, not coined. Transactions were recorded on clay tablets using standardized weight units such as the shekel. Gold entered the economy not as money in the modern sense, but as a counting metal. Between 650 and 600 BCE, a decisive transformation occurred in Lydia, a kingdom in western Anatolia, modern-day Turkey. Lydia sat at the crossroads of major trade routes connecting Mesopotamia, Greece, and Asia Minor. Merchants passed through with metals, textiles, and grain, but trade had a persistent problem: trust. Weighed gold and silver were valuable, but inefficient. Lydian rulers solved this by introducing state-issued coinage. Under King Alyattes, 610 to 560 BCE, coins made from electrum, a natural alloy of gold and silver, were stamped with official symbols, certifying weight and value. His son, King Croesus, refined the system around 560 BCE, issuing separate pure gold and pure silver coins. For the first time in human history, weight was standardized, purity was guaranteed, value was backed by political authority. Once gold became state-backed money, its role changed permanently. From Lydia, coinage spread rapidly across the Greek world. City-states like Athens used gold and silver coins to fund navies, pay mercenaries, and sustain trade across the Mediterranean. By the 4th century BCE, Alexander the Great carried coined money across Asia, Egypt, and Persia. His conquests were not sustained by loot alone, but by monetary systems that could pay soldiers regularly and reliably. Gold had become logistics. Then, the Roman Empire perfected gold as a state system. Rome standardized gold coinage to govern an empire at scale. From the 1st century BCE, Rome issued the aureus, a high-purity gold coin weighing about 8 grams, used primarily for paying soldiers, senior officials, and major state expenses. In 312 CE, Emperor Constantine replaced it with the solidus, a more stable gold coin designed to restore trust after years of debasement. Together, these gold coins funded standing armies, imperial bureaucracy, road networks, and centralized taxation, turning gold from a precious metal into the financial backbone of imperial power. After Rome fragmented in the 5th century, gold retreated from everyday European life, but it never disappeared. Silver dominated local trade, while gold survived as strategic settlement money used by states and elites. The Byzantine Empire maintained stable gold coinage for centuries. The Islamic world spread the gold dinar across trade routes from Spain to India, and Indian kingdoms stored gold in royal treasuries and temples. As commerce revived in Europe, gold returned through city-states. Florence issued the florin in 1252, followed by Venice's ducat, enabling banking, long-distance trade, and early credit systems, the foundations of financial capitalism. By the 16th century, gold was no longer the system itself, but a powerful instrument inside financial systems, setting the stage for the age of global extraction that followed. The 16th century marked the age of extraction. gold without systems. When Europe reached the Americas, what followed was not discovery, but large-scale extraction. After the conquest of the Aztec and Inca regions, the Spanish Empire seized vast quantities of gold and silver, and by the mid-1500s, controlled the largest precious metal supply in the world. On paper, Spain should have become the richest empire in history. Instead, prices surged across Europe, industry stagnated, and debt mounted, a period later known as the Price Revolution, one of the first recorded cases of inflation driven by excess money rather than productivity. Spain mined gold, but Northern Europe built institutions. The metal flowed outward, paying mercenaries, settling debts, and enriching bankers elsewhere, proving a lasting rule. Gold amplifies power, it does not create it. Britain absorbed this lesson. In the 18th and 19th centuries, it built banks, legal systems, and global trade networks, and in 1816 formally adopted the gold standard, anchoring currencies to metal, restraining government spending, and establishing gold's most stable historical role. That system survived until the shocks of 2 world wars, when flexibility replaced discipline. And in 1971, the United States closed the gold window under Richard Nixon, removing gold from money in public while quietly keeping it inside central banks. In 1971, gold was removed from money. Gold today. Global gold mining produces approximately 3,000 to 3,300 tons per year. Based on 2024 to 2025 estimates, the major producers are: China produces roughly 370 to 380 tons of gold per year, accounting for about 11 to 12% of global production. China is the world's largest producer, but exports very little. Most of its gold stays inside the country. Australia produces approximately 310 to 320 tons of gold per year, contributing around 9 to 10% of global production. Australia is the largest exporter of mined gold and a key supplier to global markets. Russia produces approximately 300 to 310 tons of gold per year, accounting for around 9 to 10% of global production. Since sanctions, most Russian gold is absorbed domestically or routed through non-Western channels. Canada produces approximately 190 to 200 tons of gold per year, accounting for about 6% of global production. Canada is a politically stable producer with strong integration into Western bullion markets. The United States produces approximately 170 to 180 tons of gold per year, accounting for around 5 to 6% of global production. Together, these 5 countries account for roughly 40–45% of global gold mining. The remaining 55 to 60% comes from a wide spread of countries including South Africa, Ghana, Peru, Mexico, Indonesia, Uzbekistan, and others, none of which can rapidly increase supply. Recycled gold contributes approximately 1,200 to 1,400 tons per year. Comes from old jewelry, electronic waste, industrial scrap. This accounts for 25% of supply. How does mined gold become today's gold? Step 1, mining. Step 2, processing. Step 3, refining. Purified to 99.99%. Converted into standardized forms. Step 4, distribution. Sent to central bank vaults, bullion markets. Jewelry manufacturers. Technology companies. Gold today exists in multiple functional forms, not one. 1. Physical gold, real, tangible. This is gold you can touch, store, and deliver. Main physical forms: Gold bars, gold coins, jewelry gold, industrial gold. Industrial gold used in electronics, satellites, medical devices. 2. Paper gold financial claims. Main paper gold forms: gold futures contracts, gold options, gold ETFs, unallocated gold accounts, allocated gold accounts. 3. Central bank gold, the third layer. 4. Digital representations, new layer. Why gold is in the news now? By 2025-2026, gold crossed the $5,000 per ounce level for the first time in history, a psychological and financial milestone that forced markets to pause. This was not a sudden spike driven by retail panic or speculative frenzy. The move unfolded gradually, supported by steady central bank accumulation, constrained supply, and long-term institutional positioning. What mattered was not the number itself, but the path to it. Gold did not surge because people expected quick profits. It rose because trust in long-term monetary stability weakened and large institutions adjusted quietly. Following that move, several major US banks revised their long-term gold scenarios upward, with some now modeling $6,000 gold by 2026. These projections were not based on short-term price momentum, but on a deeper shift: portfolio frameworks that no longer assume geopolitical stability, currency discipline, or policy credibility as fixed conditions. In other words, gold was not being chased, it was being recalibrated. Central banks are buying, quietly and relentlessly. One of the most underreported stories of the last decade is central bank behavior. Since around 2010, central banks have shifted from net sellers of gold to net buyers. This accelerated after 2018 and intensified sharply after 2022. Importantly, this buying is not speculative. They buy slowly, steadily, and with long time horizons. This matters because central bank gold is effectively removed from circulation. It does not flow back into markets easily. Every ton added to reserves tightens available supply. Just as important is the signal. When central banks increase gold holdings, they are quietly expressing reduced confidence in a purely dollar-centric reserve structure. The third driver: interest rates and the cost of trust. Gold and silver do not pay interest. This is often framed as a weakness. In reality, it becomes a strength when interest rates peak or credibility weakens. When real interest rates are high and stable, gold struggles. When rates become volatile, politicized, or unsustainable, the opportunity cost of holding metal falls. The fourth driver: supply cannot respond. Gold supply is remarkably rigid. Global mine production grows only about 1 to 2% per year. New mines take a decade or more to develop. Even when prices rise sharply, supply does not surge. The fifth driver: currency trust and debt saturation. Gold rises when faith in currencies weakens, not because currencies collapse, but because their long-term purchasing power becomes uncertain. Global debt has reached levels that historically required either inflation, repression, or restructuring to resolve. What this means for the economy. Rising gold and silver prices have consequences far beyond markets. For savers, they offer protection against currency erosion. For central banks, they strengthen balance sheets. But there are costs. Higher gold prices make cultural ownership harder in countries where gold is a traditional store of family wealth. Volatility attracts speculation, which traps late retail investors. At a system level, rising gold is a warning light. It signals that trust is conditional and stability is no longer assumed. The BRICS dimension: quiet, strategic, Misunderstood. BRICS. Countries are not attempting to replace the dollar overnight. They are not launching a gold-backed currency to overthrow global finance. What is actually happening is quieter and more durable. BRICS nations are reducing dependency on a single reserve system. They are increasing gold holdings as insurance. They are experimenting with local currency trade and alternative settlement mechanisms. None of these actions remove the dollar from global dominance. They dilute risk. Gold is not the transaction currency of BRICS. It is the balance sheet stabilizer behind the scenes. This matters because once reserve strategies change, they rarely reverse. Gold is not rising because the world is collapsing. It is rising because trust is becoming conditional. Do you think gold is rising mainly because of central banks, geopolitics, or currency risk? Or do you believe this rally is being exaggerated? Comment your view below. Thank you for watching. Beyond identities, beyond borders, beyond divisions, our destiny is one. You are watching Next Horizon Global.